right, let's get right into it. Today, we're going on a bit of an investigative journey. We're going to pull back the curtain on the modern financial system and look at the huge, unseen risks that are brewing just below the surface. So, let's dive in. So, here's the big question we're tackling today. Is the whole system really as safe as we're all told it is? After 2008, they put all these new rules in place. But are we really being told the whole story? Or are the official numbers hiding something?
I mean, if you just look at the official scorecard, everything looks, well, perfect. This is what the regulators see. Banks are passing all their stress tests, capital ratios, liquidity coverage, check, check, and check. They're passing with flying colors. The system looks rock solid. But again, that's only what you can see.
To find the real story, we've got to start peeling back some layers. And layer one? Well, it starts right in the heart of the system, the stock market itself.
So what is a dark pool? Think of it like a secret, members-only stock market. It's where the really big players, we're talking giant pension funds and hedge funds, can buy and sell huge amounts of stock completely anonymously. The key word here is anonymously. Nobody sees the orders before they happen. It's a total black box.
Now, you might think this is some small niche thing, but no way. Get this, dark pools now make up almost 20% of all stock trades in the U.S. That's somewhere between 2.5 and 3.5 billion shares changing hands every single day, all happening in the shadows.
So what's the big deal? Well, it creates this two-tiered market. The big institutions playing in the dark pools get better information and they get better prices. And the public stock exchanges, where you and I trade, well, we're left with what's left over, which is often more volatile. It gives the insiders a massive, massive advantage. All right, let's peel back layer number 2. We're moving from the stock market and into the core of the banking system itself. And the theme of hidden risk? Well, it just gets bigger here. Okay, so get ready for this. It's called a special purpose vehicle, or SPV. And honestly, it's one of the oldest tricks in the book for banks. It's basically a financial magic trick. They create this little shell company, stuff it full of their riskiest loans, and poof, just like that, the risk is officially off their books. And this, right here, is the result of that magic trick. This is the nice, clean picture the banks show to everyone. Delinquency rates, people falling behind on their loans, look totally fine. Auto loans, credit cards, it all looks low and completely manageable. Nothing to see here, right?
But remember those SPVs? The moment you add back all the risky stuff they've hidden away, boom, the picture totally changes. Suddenly, the real delinquency rates are anywhere from 40 to 100% higher than what was reported. The risk never actually went away. It was just out of sight.
And this slide just drives the point home perfectly. That reported capital ratio, a bank's main safety cushion, looks pretty healthy at 13%. But once you account for the almost 2.9 times trillion dollars of risk tucked away in those off-balance sheet vehicles, that safety cushion shrinks dramatically. A massive amount of leverage is just invisible.
Okay, so where did all that risk go? If banks are trying to hide it, it has to end up somewhere. That brings us to layer 3. A huge chunk of lending has moved out of the regular banking system and into this enormous, much less regulated space. Say hello to the world of private credit. You can think of it as a giant parallel lending universe. It's not banks making these loans, it's big investment funds. And it's all happening outside the normal banking rules. It's a massive form of shadow banking. And when I say this thing has exploded, I'm not kidding. Just look at this growth chart. From under $1 trillion just a few years ago to over $3.5 trillion today, it's become this colossal new debt machine, and it's funding everything, all outside the view of traditional bank regulators. So, why should this worry you? I mean, who cares if some funds are lending money? Well, here's why. A huge chunk of that money, nearly a third, is coming from pension funds. Yeah, the retirement savings for millions of teachers, firefighters, and workers are now directly plugged into this opaque, risky, shadow lending system. And that brings us to our final layer. This one might be the most powerful, the most explosive. It's a digital risk, but it has very, very old-school parallels to the worst financial crises in history. $300 billion. That's a huge number. And it represents a whole new kind of bank deposit, all held in digital currencies called stablecoins. People treat this money just like cash in a bank account. But here's the catch, and it's a big one. There is zero government insurance on this money. None. This quote from EY just nails it.
These stablecoin companies are doing all the things a bank does. They take your money and promise you can get it back whenever you want. But they operate completely outside the safety net. No deposit insurance, no government backstop, nothing.
And this is where it gets really chilling. Look at this comparison. Someone holding a stablecoin today is in almost the exact same boat as a bank depositor back in 1929, right before the Great Depression. No insurance? Check. No idea what's really backing your money? Check. A super high risk of a run if people lose faith? Double check. It's literally 1929 all over again, just with the digital wrap.
Okay, so we've seen all these hidden layers, the dark pools, the shadow banking, the private credit bubble, and this new risk of a digital bank run. So how does it all come together? What could possibly light the fuse on this thing?
Well, the spark might just be this: a $33 trillion wall of debt. This is all the global debt that's coming due by 2026. All of it has to get refinanced, but at today's much higher interest rates. And you know what that means? A lot of companies just aren't going to be able to pay. Defaults are coming.
And here's how that one spark could set off a firestorm. First, those defaults start hitting the private credit funds we talked about. As their losses grow, the pain spreads to their biggest investors, those pension funds and insurance companies. That could trigger wider panic, which then could spark a massive digital bank run on stablecoins, freezing up a huge piece of the financial system.
And the total damage? Well, it's just staggering. The models show that a cascade across all these hidden systems could create systemic losses measured in the trillions. That's combining the hit from private credit, the losses at pension funds, and the value wiped out from a stablecoin collapse.
So that leaves us with one final pretty uncomfortable question. We spent more than a decade building these huge fortress walls to stop the last crisis from happening again. But what if they built the walls in the wrong place? What if the real threat isn't outside trying to get in? What if it's been inside the whole time, just hiding in plain sight?